Hi, this is Paul here. Just that I've got to rush off for a meeting, so I will just start off first. Um, and okay, just a quick one because Richard is also on leave today. But anyway, we'll start off with just on Ascendas REIT. They made a couple of acquisitions, but I think that directionally, what is happening is that Ascendas is increasing their exposure to UK and to UK. I think the main purpose is that do note that most of Ascendas exposure is in Singapore, but when you're in Singapore, most of these properties are leasehold. So the advantage of going to UK, albeit there's currency risk and so forth, but the advantage of going to UK is just these are freehold assets. So you can actually extend the WALE of the underlying assets, not so much the rentals. So it's mainly that is the main purpose of going into UK. Okay. Anyway, we still like Ascendas REITs because we think the yield is attractive and they've got a huge number of properties that is well diversified. Okay. Move on to just the weekly updates. Sorry, I have to leave after this, but if you have any questions, you can just post it later. Okay, in terms of week 41, in terms of what happened, some of the key macro events for the past week, obviously, the global PMIs are still trending down, except US. And I think as we all can see from the headlines, the US unemployment is close to 50-year low or 1969 low. I think the most important event probably was the 10-year US Treasuries. We've seen a steep rise to more than 6-year highs. And more importantly is that what we see is that it's actually breaking down the 37-year downtrend in US Treasuries. So I think that's obviously very significant, and it just means that we are on a multi-year uptrend in interest rates. What the interesting thing is why it's not so much the increase in interest rates that was a surprise. It was I guess the steepness. And worth noting that actually inflation numbers is not exceptionally strong if you look at the tips. And also there's always this worry of deflation shock from emerging markets, but still interest rates, the US Treasuries actually broke to new highs. I think there could be a couple of reasons why. Firstly, the ISM, the US non-manufacturing index, is actually at 20-year highs. And as you may know, a couple of days ago, Jerome Powell actually commented that the Fed rates are actually still a long way from neutral. Long way means there still could be upside in terms of the Federal Reserve raising rates from what market expects. Of course, another reason why the US Treasuries could be spiking because, as you know, the federal deficit in the US is rising, and also there's this nuance of the expiration of tax benefit by corporates when they invest in the pension funds. So when you park money in corporates park money in pension funds, they actually get a tax advantage, and this affects demand because once the money goes into pension funds, it is usually invested in US Treasuries. So when that flow stops, then that may also affect the flows into US Treasuries. Okay, in terms of Singapore macro news, this is slightly dated, but anyway, there has been a population growth in 2018, came in for Singapore at 26,000. Whereas if you look at the 10-year average, 2008 to 17, it's about 102,000. So this is quite a meaningful slowdown in terms of population growth per year. Because as you know, that when there's lower population, you affect retail spending, healthcare spending, F&B. So this is somewhat of a structural drag on the domestic spending in Singapore. A slightly better news has been the new order PMI in Singapore came in at 54.2, whereas a year ago was 53.1. So this could actually help support at least the GDP for Singapore. In terms of the key event for this week, it will be the MES, of course. It will be as you can see from the bottom, 12th October, we have the MES monetary policy statement. As you know, in April of this year, they moved the Singapore exchange rate or the NER from zero appreciation to modest and gradual appreciation. So in October, when it comes to October or 12th of October, there are three things that the MES can do. They can widen the band, they can move the slope up or down, or they can move the midpoint. Unlikely to move the band because it's only when there's a huge volatility in the exchange then only you want to kind of narrow the band. So most likely, we think it could be expanding. They could rise the slope again slightly. moving the midpoint is actually very aggressive, so that's unlikely. So what we think they could do for the monetary policy statement is to maintain a modest and gradual appreciation, but actually even increase the slope again up slightly. The only reason to do that is because core CPI is reaching the MES target of 2%. The latest reading is 1.9, so it's already meeting the target. Okay, and just quickly on the corporate news, of course, we have Chip Ing-seng. They sold 29% stake at 108. Our target is actually 1.21, which is a 40% discount to RNAV. Again, the reason why we like Chip Ing-seng is because of apart from the valuations, is also because there's quality in the valuations because most of their projects are sold. And at the current price of, let's say, 88 plus cents or 90 cents, they're paying a 4% yield. And the yield is based off mainly from their construction profits, not even touching the property profits. Okay, the other news, corporate news was Sembcorp Industries. As you know, the speculation that they're the only bidder for high flux Tuas Spring, and they will be buying. The rumors they buy below book value. On paper, this is not a good acquisition. Firstly, because Tuas Spring is losing money. In the first quarter, they lost 23. So if Sembcorp really buys this, you analyze this, you're buying an asset that is losing almost 80 million a year. And not only that, when you buy this asset, because it's project financed by Maybank debt, so you not only do you lose money, you're also taking on a debt of 602 million. And this excludes Hyflux as a shareholder loan to Tuas Spring. So it's also unclear how that is going to be settled. But we don't think Sembcorp is won't. If the only reason Sembcorp can buy this if they can get some really, really good deal. So buying below book value could, I mean, we're just speculating, it may be positive in the sense that if you buy it below book, you can actually kind of amortize some of the gains and kind of offset some of the losses that you have here under 23 million. So again, this is just pure speculation. There's no details on this. Do note that on 15 October, Hyflux must have some resolution with Maybank. Otherwise, Maybank will do some enforcement on their loan on Hyflux. In terms of tactical, again, we are still cautious. Those are boring stance, but it's still cautious because the backdrop for equities is not good. We have rising interest rates and you have also slowing global growth. And then again, you have the US midterm elections. In terms of some tactical, in terms of a strong US Sing dollar, it will be marginally positive for the REITs because as we compare Sing dollar compared to the region, we probably stand up for the strength. And it's also positive for importers like, maybe like a Sheng Siong or even Old Chang Kee. Okay, anyway, that's it all for me. I will move on to Minion. At the bottom is just some of the key events to watch out for the next few weeks. Yeah, thank you. Hold on, Minion. Yeah.
So moving on to the Singapore Bank Claim monthly update. So for Singapore and Hong Kong loans, SG domestic loans growth rose 5.6 year-on-year, and this is in line with the trend year to date this year, and also driven by business loans that rose 7% year-on-year, and consumer loans rose 3.5%. So it's driven by car loans and also mortgage loans. So interesting thing to note is that despite the 52 basis point increase in SIBOR this year, mortgage loans remains quite resilient at 3.7% increase year-on-year. So we do not expect the banks to experience slowdown in property-related loans due to the property cooling measures in the near term due to the drawdowns of previously approved loans. So for Hong Kong, it grew 8.4% year-on-year. It's the slowest in almost 2 years, and this is mainly due to the various cooling measures that the government has, and residential sales volume went down as well as value. So Hong Kong banks are also increasing their lending rates, and we hope that the ability to charge higher lending rates could offset the eventual and the sequential rise in cost of funds as well. So however, the higher cost of borrowing might discourage home buyers from taking on more loans, and also uncertainties from the ongoing trade war escalation could also result in a slowdown in loans growth for Hong Kong as well. So for SG margins and deposits, for 3 months, SIBOR, it rose to 10-year high. It continues to break records for this year. And 3 months saw maintain its strong ascent. And savings rate remained unchanged at 0.16%. So we are seeing more and more net interest margin expansion. And this bodes positive results for the third quarter. So for deposits, In anticipation of the steeper interest rates with more Fed rate hikes, banks have been bulking up on their fixed deposits to strengthen their funding position. So deposits increased 2.2% year on year, and we saw that in second quarter, fixed deposit grew quite substantially for the banks. And in September, the deposits growth was the fastest in 10 months. So this is also stimulated by the rebound in deposit growth by the government and statutory authorities, such as the Singapore Savings Bonds and also non-bank financial institutions. So as the banks bulk up on their fixed D, the bulk of it belongs to pricier fixed deposits. And if the banks don't manage this cost of funds well, this could result in a squeeze in net interest margins for the third quarter and fourth quarter results. So for Hong Kong margins, HIBOR as usual continues on its upward trend, especially since Hong Kong Central Bank lifted its borrowing costs, followed by the Fed rate hike last month. So we believe as HIBOR increases, the bank's ability to achieve marginal increases in net interest margin will more than offset the increasing funding costs. And for oil and gas sector as usual, day rates are recovering, utilization is also recovering, but they're not recovering fast enough because of the issue of oversupply, which makes it increasingly difficult to increase the prices. So oil and gas NPL has stabilized for this year, but we do not expect recoveries to be consistent every quarter. So any recoveries made will be a bonus to the bank's results. So overall, we maintain the Singapore banking sector at buy, and this is mainly due to we are being positive on the sector's continued net interest margin expansion due to rising interest rates. Loans growth is expected to remain on target for 2018, and also dividends is also a share price catalyst for the banks this year as well. So we believe that the positive surprises in net interest margin expansion could more than offset the uncertainties that the trade war could bring to the bank's loans growth. So in conclusion, the banks continue to enjoy dual drivers of expanding loans volume and net interest margins this year. And these are the following target prices. So we have come to the end of presentation today. Any questions? Oh, actually, Mike is in the office, so he will go through with you the China September CPI.
Here, from the point of the CPI and yesterday's the foreign exchange reserve, I want to explain the pressures of RMB depreciations on the PBOC. From the historical circle of the Chinese inflations, we can see the pork price and oil price are the two main factors to affect the Chinese CPIs. The green lines and the red lines shows the price movement of the pork and oils. Historically, these two sectors usually move in opposite directions, which will cause the relatively low CPI, which is the blue line. But since the 2018, we can see these two sectors are actually increasing together, which caused the CPIs in February to reach the 2 years high, which is 2.9%, with a higher oil price and on pork price. Since last month, we are expecting a higher CPIs. Yesterday, China refused its foreign exchange reserve, which is lower than expectations. Shows about $3,087 billion. This is the foreign exchange reserve decreasing the 2 months in a row. From here, we can see the increasing pressures on the Chinese on the PBOCs. On the RMB depreciations. So the question is, will the PBOCs increases in interest rate? The answer is no. To explain the answers, we need to know that first, the PBOC is not the decision makers of the monetary policy. Secondly, we need to know that the main priority of the Chinese government is still the deleveraging and the cost reductions. So from the perspective of the Chinese government, we can understand why PBOC cut down its reserve rate. PBOC on Sunday, PBOC cut down its reserve rate to about 1%. This is the fourth time the PBOC cut down its reserve rates this year, which will bring about 1.2 trillion billion RMBs, and of which 415 billions will be used to repay existing MLF. So, so actually, we are expecting stronger and positive fiscal policies on October. The 19th Central Committee of the Communist Party of the Chinese is supposed to happen this month. So we are expecting the higher and the stronger positive fiscal policy to stimulate the Chinese economy. Let's 这些还是说什么？我说完。So if you have any questions, you can leave at the question board.
For the Ascendas REITs question and the Chip Eng Sing question, because Richard and Paul is not in right now, could I ask you guys to post your questions on Stocks BNB, and then they will get back to you when they are back? Thank you. For the bank's target price, we're looking at a time frame of 3 to 6 months. Okay, if there are no further questions, we will end our webinar for today. Oh.
The SSEC index decreasing about 2% after a week no tradings, and we think it's because of the stronger dollars causing the valuations problems. Also, the increasing oil price also put the pressures on the stock market. So if there's no more questions, we will end the webinar today.